Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. This week up, we are going to look at Restaurant Brands International, better known as Burger King or Tim Hortons. They also own Firehouse Subs and Popeyes Chicken. Let's take a look at this restaurant brand with over almost 30,000 units across 100 countries globally. System-wide sales almost $30 billion. Let's figure out how much money, how much cash flow this enterprise makes and what we think it's worth. Ready? Let's get to work. What we're going to do with this review is, like all companies that we look at here, this channel, we're going to evaluate based on 5 key factors, key attributes. We're going to figure out what those are, and then we're going to look at the risk-reward trade-off of buying the stock today, holding it for a decade or longer, and seeing how much money we think we can make. Can we beat the market? The 5 key attributes that we use here at the channel are top-line revenue growth. We got to be growing. Number 2, EBITDA, enterprise level earnings should be growing. Number 3, strong free cash flow. Number 4, low debt. We want less than 3 times debt to EBITDA. And number 5, we want a well-priced stock. What is a well-priced stock? A stock that, with a conservative forecast, will beat the market. That's what we're trying to do. And we look at all stocks in the channel with those 5 key attributes to judge them against each other, because there's only so much money you can put to work, so you pick the very best of the best. Okay, the first thing we want to do is, I've got the annual report for Restaurant Brands behind me. Let's take a look at what the split is of their revenue so we can see what the biggest product is and what's driving the underlying business. All right, behind me is their 10K, right? This is the last issued 10K from December 31st, 2021. System-wide sales, this is with growth, sales is down here, in millions of dollars. And you can see that Burger King is the largest at $23 billion. In the total sales that they had, $35 billion. This is system-wide sales. So they're a franchise, they sell franchises. So this is what they own plus all the franchisees. $35 billion total system-wide sales. They just bought Firehouse Subs, so that's kind of like an add-on. They're about $26 billion total revenue. Burger King itself is the vast majority, with Tim Hortons and Popeyes being kind of equal. So think of this as basically Burger King with added onto that some coffee and some fried chicken. And new Firehouse Subs, hopefully they can continue to grow it. Let's go take a look at their financials and figure out what this company generates. Revenue for QSR, so Restaurant Brands International, $1.1 billion. That includes what they sell from the restaurants they own, plus the franchise fees for the restaurants that they franchised out. $1.1 billion up to $37 billion over these 9 years, with some notable chunks where they've acquired businesses here, and the Tim Hortons, which is fairly new right there. So they've grown through some acquisition, but they've also grown the per store units that they've owned over time, where that's been franchised out. And we'll see later on, profitability per store has been growing, which is nice as well. EBITDA has gone from $580 million to $2 billion over this time frame. That's an annual growth rate of 17% on profit versus a 22% of top line revenue. Again, including franchise revenue, including some acquisitions. So they've got both organic growth, and they were able to find new brands to grow, or even buying back franchisees that couldn't run their businesses as well. So I kind of like that. They're both profitable. They're both going the right direction. They have been profitable the entire year and continue to, with the exception of a couple years, they continue to march forward in terms of size and growth. Let's take a look at debt and enterprise value. Debt levels here, $3 billion to $13 billion. That's a 4x growth rate on the debt. That's pretty high. 20% annualized. And that's mostly because they've been making some acquisitions. They use a lot of leverage to build out the locations that they own. So that is growing. It's a little faster than I would like, but let's see how it stacks up to profitability, which is the true measure of how much debt they can carry. No excess cash, and market cap. Market cap is average share price times shares outstanding, or fully diluted shares. $12 billion here is market cap to almost $30 billion as of last fiscal year, December 31st. If I add the debt plus the market cap, I get enterprise value, which is the true size of the business, right? Think of a home. If you were to buy a house, you would go into the market, you'd pay X price for a house. Then you'd go to a bank and you say, hey, I need a mortgage, a loan, plus your down payment. Those two, the debt and your down payment, equal the value of the house. Same thing here. Enterprise value is the combined value. What trades in the stock market is only this piece, and it's very, very important you look at the entire value of the business, because in this instance, QSR has a lot of leverage, and a $13 billion of debt on a $30 billion market cap is a sizable amount of debt, and we want to make sure we don't forget that when we're only looking at the stock price. So as you can see, debt off to the side here, I'm looking at net debt. So it's debt minus cash. They have no excess cash. So it's just this number divided by the EBITDA. And EBITDA is their annual earnings before interest, tax, depreciation, and amortization. And what we're doing is we're trying to figure out how many years do they have to operate to pay off their debt. Not that they're going to, but it's a relative gauge of risk. How many years must they operate to pay down their debt? And if something happens, earnings fall, that debt ratio is going to go up much higher, much faster, and that's a risk of bankruptcy to us as equity owners, right? We are behind the debt in our ownership of the collateral of the business. So if something were to happen to the business, the bank would take everything and our equity could be worth zero. That's why it's very important to watch this ratio. And our metric, right, is 3 times debt to EBITDA. We want to see companies with less than 3 times debt. And you can see here, they've maintained above that this entire time, and they're currently at 6.4, down from 8.5 when earnings fell during the pandemic. That's a very high number. 6.4 is also too high for us. So that's a concern, and I would like to see them pay that debt down to bring it back in line. Not that they plan to, but that's for us as cautious, prudent actors. We want to see them pay that down. On a value basis, enterprise value divided by EBITDA. Now this is how much earnings annually, or how many years of earnings does the business need to require to pay for itself. It's a relative value metric, much like this is relative to enterprise value versus EBITDA. And what you're going to see here, it trades at a very high range for a business that seems to be fully levered. But with its growth rate, the acquisitions they've made, the street is giving a lot of credit on the market cap side to this ratio, and we're trading at a higher level than we normally see for businesses that cash flow like this. 30 times is a very high premium, 26 times. As you get down, maybe 20, 17 here, 15 is a decent price. On average, 22 times earnings is a decent premium for a business. And we're going to have to figure out what market multiple do we want to assign to this business going forward to make sure that we don't pay too much of a premium if, as we're seeing in this economic collapse, market multiples come down. And that can really hurt the return, even if cash flow is growing, but the market does not want to pay the premium for the stock. You're going to get hit there. So we've seen revenues growing, EBITDA is growing, leverage is questionable, probably too much leverage. Let's take a look at cash flow and see how much they've been generating cash flow. Okay, cash flow begins with cash flow from operations. Cash flow from operations, it's the top third section of the cash flow statement. $325 billion to $1.7 billion. That's a growth rate of 23% annualized, and it lines up with the EBITDA growth rate. So we know that the accounting team is expensing cash costs properly. They're both going in the same direction. Good job, accounting team, for keeping it straight. I appreciate that. I really do. So they seem to be growing well in cash flow from operations. CAPEX is how much they pay to put back to build out their stores, to build out their brand, or maybe even update the existing infrastructure that they have. And this ratio here is really small, which is what we like. It doesn't cost them much to build the units that they're building, but the cash flow they generate from their entire system-wide network of franchise fees, plus the cash flow from running their own businesses, is very, very strong, and we do really like that. Debt payments themselves, relatively small. When you go through their debt schedule, they don't make a lot of principal payments. They end up rolling the financing a lot, which we'll get into in a little bit. So when I add these all up, I get free cash flow to equity. This is the cash flow that's available to the common stockholders, and it's after the debt payments. And you always want to make sure you're looking at cash flow after principal payments of debt, so you know the true number that you're getting. A lot of cash flow numbers that people report is this cash flow, and it removes or excludes the debt payments that they have to make. And in an instance like this, we have a company that's fully leveraged or over-leveraged in terms of our benchmark. It's excluding the debt payments, and that's not true free cash flow the way we like to look at it. So this company generates about $2 billion of free cash flow, maybe 1.5 if I take out this debt of cash flow. If I put it against the share counts, now they've been issuing a little bit of shares here over the time frame. They've gone from 358 million to 464 million shares outstanding, and that's probably due to the acquisitions they've made. They've had to raise capital, both debt and equity, to go get Firehouse Subs and get Tim Hortons and do those big acquisitions. But it's resulted in higher earnings, so that generally they've been accreted to the business, accretive to the cash flow, which is a good thing. We at this channel like to see this going the other direction. We like to see companies that generate free cash flow and buy down shares. They're kind of in growth mode. They're leveraging themselves. Certainly in the past decade, with interest rates as low as they have been, it's a very profitable strategy, and you can see that from the way they've grown their market cap to 12 billion to 30 billion. It has really well worked from them. I think going forward with interest rates higher, their strategy of rolling their debt into lower rates has changed, and the amount of leverage they're able to use when they build out new stores is going to change as well. This is going to be interesting how it plays out in the future. Free cash flow per share, this is just I've just taken the $2 billion of free cash flow divided by the shares, and I get about $4.45. If I were to zero out the debt for a bit of a truer number, you're at $3.50 a share, $3.50 a share. It has been as high as $63 recently. That's a 5.5% free cash flow yield. I'll put back the debt just so my model works fine. But that says, the business is yielding about 5.5% free cash flow historically, and it's decent, but it's decent. It's probably it's decent. I think that's all the only thing I can say. It's not great. It's not terrible. It's meh. All right, let's take a look at how we can forecast this business. All right, before we forecast this business, I want to touch on something regarding their debt. I want to go to page 77 of their 10K, where they list out all the individual debt by line item. And you can see the total debt on the prior page. They've got about $13 billion outstanding of senior secured notes. 2021 outstanding balance. They've got loan A and B here for about $6 billion. And they have a really large note here. It's 4% note at $2.9 billion. These are probably the biggest chunks of the debt. These notes here are fixed rate notes. It has the interest rate stated to it, 4.25%. On the 1 point, that one's zero. 3.875 on the $1.55 billion of outstanding debt. So this is fixed rate debt. This is variable rate debt. I'll show that in a second. But what I wanted to say is this note here, the largest note, they refinanced a higher rate note at a 5%, and they paid about $80 million to do that. And they're rolling the debt rather than paying it off. A lot of the term structure in here says, hey, just pay me some interest. You don't need to give me the principal payment. And what they did is they said, I'll pay the bank an $80 million fee to refinance their debt early from 5% to 4%. And they also got to skip principal payments by doing that. They extended the term of the lease, which is fine in a declining interest rate environment. As in a rising interest rate environment, they're not going to be able to do that going forward. They're going to have to make those principal payments, and I think that's going to reduce the cash flow that's available to investors for acquisitions, for dividends, to build out stores, because they're going to have to make principal payments on this large debt. I also want to show you that A and B loans, which is very interesting in a rising interest rate environment. Again, many companies right now have a lot of debt, and you are not seeing the impact of rising rates on the financial statements yet because of a floor rate that's built into the credit facility. And if you read through this, and it's page 77, please read it all. It lays out the debt structure for corporations very, very nicely. You've got both fixed rate debt and you got variable rate debt in here, and it shows you how companies write about it and how you can tell what is fixed versus variable. One thing here you'll see, it makes reference to a floor rate right there. So base rate subject to a floor of 1%. What does that mean? That means that the interest rate on the loan can go as low as 1%. So when the Fed funds here in the U.S. had dropped rates to zero, this loan would have gone below 1%. But the floor rate says, no, you owe me at a minimum 1% on this debt. So what does that mean? The historical financials reflect the 1% because interest rates were less than 1%. And as interest rates climb, it's going to take a while for them, A, to get to 1%, and then B, surpass 1%. We're now at 2.25 at the Fed funds level, which has been raised very, very quickly in the last only couple months. So one, the interest rate has to get past 1%, and then two, time has to elapse for the company to have to report numbers for another quarter before you start seeing that increase in interest rate. And what the market is currently missing, the market is not seeing the financials for the companies that have operated in the above the floor interest rate environment so that higher interest cost is then reflected in the financials that they're reporting. And I think going forward, we're going to see some surprises from companies whose debt is variable rate. And that debt reflects at a higher interest expense, lower net income, lower earnings per share for companies. And that is interesting here. You want to take a look at. It's not the biggest part of their loan portfolio, thankfully. Most of it is fixed, but they still have, that's still half of this number is variable rate. And as interest rates climb, again, we're at 2.25% at the Fed funds. This rate here is a floor of 1%, so that's already double 2.25 versus 1. That's more than double the interest rate cost on half of their debt portfolio. Very interesting. Please keep in mind, always read the debt details of the businesses you're investing in. Okay, how do we forecast this business? We want to forecast a per store, per unit company like Restaurant Brands on a store basis, much like we do with Starbucks, Chipotle, anything that's on a per unit basis. I've put all kinds of businesses in the cash flow club, by the way. They're very interesting. But what we're going to do here is we're going to pick up the number of units that they have now, have being franchised or otherwise, compare it to their earnings and see what we got. So they had 17,000 stores in 2012, and that's grown to just shy of 29,000 stores in 2021. I'm taking their total revenue divided by the stores for an annual number of $200,000 and $70,000 of EBITDA. And this is their revenue divided by total stores. It's not a perfect representation of what the stores themselves generate, but it's a benchmark that we can tie their earnings to the number of units in their network and do kind of a relative, as the network grows, what does that impact mean to their revenue and EBITDA? So I can say that per store revenue, per store EBITDA, growth rate of the stores right here. And you can see the stores have been growing even when they don't acquire companies. The stores are growing in nice single-digit numbers. And what I'm going to do is I'm going to string that out at 2% going forward. I'm going to say they're going to grow their network 2% every year, which I think based on these fives and these fours is a decent number to use, putting aside any large acquisitions that they might do. Okay, I'll then look at, this is profitability per store, revenue per store. And I'm going to say revenue per store is going to grow at about 5% in the near term. I held 0 this next year, but I would say 5% in the near term. And then I'll bring that down over time as they kind of scale. Then what I do is I simply have the store count. I've got the revenue per store. I multiply those two, I get revenue, which is over here, and I can apply a margin to that revenue. Like we do here. So here's their revenue. That I've shown you this already. This is the $5.7 billion you just saw earlier. But by building a per store model with revenue, I can say here's my revenue forecast. And then if I look at their EBITDA margin, historically it's been really nice, 50%. But most recently 29 and 39, 36. I'll say 35 is my estimate long term, and that's how I get the EBITDA. Pretty simple. Gives me an EBITDA forecast. I can then take some ratios and come up with what I think the cash flow is, CAPEX, debt payment. So I'm going to stop here for a second. I'm going to talk to you about the debt payment. What I'm going to do is, because they're over leveraged, in my opinion, right? 8.5 times debt to EBITDA is too much. I want to see 3 times. So I'm going to force the business to pay down debt. This isn't necessarily what they're going to do, but the criteria, the threshold for me to invest in the business is having a cash flow to either sustain that debt payments or have them bring down the debt. And what I'm going to do is I'm going to say they're going to have $13 billion of debt. That's the current debt outstanding. If I give 3 times last year's EBITDA, that means they should only have $6.2 billion of debt. That means they have to pay $7.1 billion of debt down. Well, to do that on a 10-year basis, I need $714 million annually, or $1.54 per share. And what I'm going to do is I'm going to put that into my cash flow. I'm going to force them to pay the debt down, and I'm going to put free cash flow on a per share basis. And it's going to be less than what they're currently generating, because I want them to conform to the box that I'm filtering the market in, if that makes sense. Okay, the last thing I want to show you before we forecast this business, show you what the forecasted per share price is just to give you some zoomed out context. I went through those numbers on the model pretty quickly, but I want to show you a visual representation. The blue bars are the total units that they have in their network and that they've owned, and the orange line is the EBITDA per store. And so what I'm trying to look for here is A, store count is growing, and B, it looks like profitability per store is in this $70,000, $80,000 range, and it's kind of going north in a long-term trend. So if we're applying a little bit of inflation to earnings, then at a stable margin, this should lift per store over time and head towards about $90,000 a share per studio. $90,000 per store EBITDA. Long term, and then times the number of stores, you get the EBITDA number that's in the forecast. All right, let's figure out how much the stock we think is worth out 10 years. Here we go. So we've got an EBITDA forecast that I showed you before, and that is built up on per store, revenue per store, EBITDA margin, and I get $2 to $3 billion out long term, $3.2 billion. And that ends up being a 17% annual EBITDA growth rate, which is really close to what they had before. So long as they were able to continue to do that, either through an acquisition or per store growth rate, they should be able to get that number. What I am doing is I'm lowering the EBITDA market multiple. I think that paying 20 times for the business is a little rich. For a business that's fully leveraged, certainly as high as 30 times. This stock has always traded kind of an elevated value, and I think that as much as I like the business, I'm not willing to pay 20 times for that company, for that cash flow. So I'll give it a 17 times, which I think is a little bit more reasonable, even though it's growing really quickly. I don't want to both grow it very quickly and have a high multiple. I think that's too much risk. I'm going to bring the multiple down to kind of like temper the enthusiasm for the cash flow. That gives me a $54 billion market cap, less the debt, which I forced to be 3 times EBITDA. Divide by the shares gets me $104.70 long-term price target for restaurant brands. Okay, free cash flow is going to be a little different, right? Because I'm forcing the buy down of debt. The EBITDA valuation excludes the cash flow from the debt at the very least. So what this has done is taking the $3.50 that we saw earlier historically, and it's saying, hey, you're over leveraged. I want you to buy that down over the decade. This is the cash flow that's available after the buy down. I apply a 5% cash flow yield to that, which is what I showed you before it traded at after the debt payment, and I get a $55.50 price target out 10 years for the free cash flow method. All right, here we go. Now we've got 2 different estimates. I've got a free cash flow method, and it's producing a valuation at $55.50, and I've got an EBITDA market multiple method that's giving me $100.04. And then this is a big difference, right? These 2 variables here are dramatically different, mainly because I'm forcing the debt payment down, whereas EBITDA somewhat excludes the debt because EBITDA excludes on nature the interest payment. I'm going to go ahead and weight these differently. This is normally 50-50 because they're normally fairly close and I don't make a distinction. But in this case, I do want to make a distinction and I want to weight the cash flow more because that's what we are. We're cash flow buyers. It's over leveraged. I want to protect my investment. So as a cushion, I'm leaning towards the cash flow value for a weighted average of $67 a share. I can currently buy all the stock I want for $51 a share. If I look at a couple current metrics based on the current market price, the free cash flow yield is 3%, which is lower, right? This is the forward cash flow I'm using, and it has removed the debt payment. The current enterprise value of the business is $37 billion, which is a lot less than the $60 billion we saw previously. And on an EBITDA multiple basis, it's trading about 18 times, which is only slightly higher than the 17 I'm using in the long-term forecast, and certainly remarkably less than what it had traded in the past, as high as 30 times. And that's a big, big move. Remember, if cash flow is the same but the market multiple changes, your stock price can be cut in half. 30 times cash flow versus 18 times is almost half. But the cash flow could have been identical and the stock value half. So it's very important not to pay too much for the cash flow that you're buying. But we're going to go with this. Let's put it in the IRR model and see what we get. So here's our IRR model, right? We're buying it for $51 a share. We're getting the post-debt relative cash flow that we own that they can use to acquire new businesses. They can dividend, they can buy back shares, they can do what they want. And what it produces is a 7% IRR because we're forcing the debt down and we're waiting on that cash. And for us, this is not an attractive IRR for the business. And what's interesting though is if I change the debt leverage ratio, let's go back and say, hey, you know what? I'm fine with the 6 times debt ratio. I don't need them to pay down debt. Just keep it. What does that look like? Presto, you got a market-beating return. So I think for this company, it's really up to you. The current market multiple of 17, 18 times is definitely cheap historically. They've been proven to be able to grow. I'll put that debt ratio back. They've been proven to be able to grow by acquiring new brands or executing on the brands that they have. They are fully leveraged, which is holding back the return in my perspective. So it's really up to you. If you want to maintain the standard of less than 3 times debt, then I think it's a pass. If you're okay with the leverage and you like the brand a little bit more risk, then it looks like it might be an attractive return. For us, let's recap the 5 key factors. All right, number 1, top line revenue growth. Yes, it's there, it's growing. Number 2, EBITDA. EBITDA is growing. Number 3, strong free cash flow. Yes, cash flow's there. It can even pay down the debt, still there. Number 4, low debt, no. Do not check the box. Debt is not in our 3x level. And number 5, is it well priced? Yeah, it does look like it's well priced from where it has traded historically. So what we're going to do is we're going to give this one a meh. Meh, because the leverage ratio for me is a deal breaker. There are other companies that have a whole lot less debt than that, but still grow at this kind of rate, still have this per unit economic feature that we can leverage on. So for us, it's a pass. But if you want to disregard the debt, it does seem to be an interesting play. I'll give you the standard breakdown here, $51 a share. As the price recovers, goes north, it's obviously less interesting. I think it'd have to fall at the 40 or less range, which is highly unlikely, but it could. 40 or less range for us to be interested in the stock based on the amount of leverage it has. Okay. Did you like Restaurant Brands International? What'd you guys think? Tim Hortons, Burger King, Firehouse Subs, Popeyes, $35 billion of network sales, 30,000 restaurants over 100 countries. Very, very interesting company. I like this business. I like the company a lot. I wish they had less leverage. I would encourage you now, shameless plug, to subscribe to the channel if you like the stock or like what I'm doing. And then B, check out my website, cashflowinvestingpro.com, where I teach a course. I give you this financial model. We go through Apple and I teach you how to analyze stocks so you can create companies, forecasts for stocks you want to buy, and you can follow their earnings, you can track their business, and you can have a bit more comfort about where you're putting your money. Not to say that we're going to be right or that I'm right. This is just a guess behind me. But if it's your own guess, you will learn a whole lot more and hopefully have more commitment to stick with the investment, which is the true value of investing is holding long term and it's time. It's not necessarily getting the future right in a forecast. So take a look at the course. I go through and I tell you how to pull the material from the 10Ks, how to calculate EBITDA, how to calculate free cash flow, how to calculate fully diluted shares, how to add back for splits. And then we build a forecast together. And we also look at how to build a portfolio of 20 to 30 stocks that you can own for long term and go do something else with your life. Don't trade. Most of the trading that people do, even if you do gain, you owe the government 30% of that gain from taxes, and you're then starting at a lower number to try to continue to grow. And it's kind of a hamster wheel. Pick the very, very best of the stocks. Get 20, 30 of them and hold them for your lifetime and probably be far better off than the constant CNBCing of the stock market. So check that out. You can also subscribe to the Cash Flow Club. Now, I will say we've got a lot of people in there, and we're hiring analysts to help build out the network. What I'm doing is I'm publishing in there one-pagers, which are single-page summaries of stocks. I do a lot more stocks in there than I can possibly write for the YouTube channel. But what you get here with this is you get a 10-year look. You get the summary of the 5 key attributes off to the side. You get both the cash flow forecast and the EBITDA forecast. You get the IRR model, you get a stock chart, and you get a written out explanation of kind of the key factors of the business and whether we think this business is generate the proper amount of free cash flow to warrant an investment. It's not a recommendation for investment, but it's basically a global picture of what we think this business is generating and how it applies to our 5 key attributes that we use. So check it out, cashflowinvestingpro.com. Thank you very much. I really appreciate that. Up is going to pop. Oh, last thing is on that website in the upper left corner, when you click the Cash Flow Club, you can scroll down and I give a free cash one-pager away so you can see what that style looks like. Go ahead and check that out. Now, Up is going to pop now a couple other videos. If you like the type of work that I do, check them out. Lots of value stocks. Throw a comment down below and let me know what stock you want to see next. There's lots of value hunters on this channel, and we're kind of debating various cash flow from companies. Definitely check that out. Okay, my name is Cameron Stewart. This is Rational Investing. Thank you very much for the time. Greatly appreciate it. Have a great day. Bye-bye.